Joining us now is Frances Stacey, economic strategist and wealth manager for Scarlet Oak Financial. Good morning, happy Friday, Frances, and thanks for joining me. Let's talk Boeing. Every time I key this stock in, I'm so impressed by the performance. Let's start with just general thoughts on Boeing, then we'll get into some of the news that was made this week.
Yeah, general thoughts on Boeing is basically, obviously they had, catastrophe, safety issues. It's been a number of years since they've had that. They've got their 777X, which is yet to be certified, but it's looking good for the rigorous testing for the, FAA. And this fact that it isn't yet certified is not quelling the order demand. So that's very important. Boeing is also America's largest exporter. They had some trouble with some strikes, and then Liberation Day wasn't necessarily good news for Boeing. And so I think that is why the Trump administration really focused on upping those orders in his Middle East tour.
Frances, when we talk about Boeing and what role it plays in trade negotiations, it seems to be a big part of it. I mean, naturally, it's one of our biggest exports, one of our biggest manufacturing companies, and with the goal of the administration pretty clearly being to increase our exports and bring down some of those trade deficits, seems like a natural fit, and it seems to be working out pretty nicely for the stock. Do you think this can continue that way?
Yeah, so it's very interesting when you really look at the earnings. It really hasn't had a profitable year since 2018, since before those catastrophic accidents. However, and of course, the stock price is nowhere near where it used to be, but the future looks bright. If you look at the really, really long-term chart, we are still making higher lows. And as long as we don't have any catastrophic safety, they are the leaders in the wide body market. I think Airbus still kind of has the market cornered a little bit for the narrow body. But Boeing is probably on the upswing and supported by the administration because, as you say, it is very important to their agenda. And so we just kind of now have to see, okay, so how does Boeing manage its balance sheet? How does it manage its CapEx spending? Where do tariffs actually land, and do those calculations against the recent demand?
Frances, my question for you and this is maybe a little bit more of a nuanced one, but I think it'll make sense. When I go back to early in my career, Boeing in many ways was like the class of the market. It was every single market environment. It was going up. And then it was faced with the safety issues that you described. But then also the pandemic really impacted air travel and flights and things. So it was almost like it had this really micro misstep. Lasted years, had a macro market force that was working against it, and it's led to Boeing, what was once kind of like a must-have investment, being just a drag on the portfolio for almost a decade now. Are we past those things enough that confidence can truly return for investors in Boeing?
I think we are. Obviously, those safety concerns were a number of years ago. They've been turning out planes that have not had problems. I think the endorsement, the recent endorsement with the Trump administration securing 210 planes, a huge order from Qatar, and then another 28 planes, I believe, from Etihad Airways. Travel's not going to slow down. You really only have Boeing and Airbus. And so I do think that this is something that you could potentially put back into the portfolio, and watching for obviously idiosyncratic risk, which seems to have passed. As far as, it would be cheap today if they could reconcile their balance sheet into positive earnings per share. And I would just watch it closely, but I don't think like you said, it's kind of a blue chip classic. So, and it seems to have passed the worst.
It does, too, seem to feel a little bit different in this rally. I know there's been a couple fits and starts throughout this whole ordeal, but many of those seem to be on like, hey, we're past the safety inspection, or we think we fixed this, or we might be getting new orders. It seems like now there's like real tangible forces behind this. And it's like daily we're getting this news. So as we look ahead the next 6 months, year, beyond that, does Boeing actually have the infrastructure in place to deliver on these promises and orders? I mean, it seems like they have manufacturing issues sometimes as well.
Yeah, I'm not enough of a deep dive expert on Boeing to know, but it doesn't seem to be. They are promising delivery. They're upping their delivery as long as they don't have employment issues. Now, they're still going to be subject to macroeconomic risks if
Of
we
course.
have any problems. If we have a recession, we are fairly correlated here with the S&P 500 and those sort of things with regard to the stock price. And so there is that notion, but they seem to have their woes behind them, and just we just like anybody else, we just kind of have to watch the news. But it looks like these orders are strong, so it's just based on whether or not they get that certification for the 77X, because 777X, because that is one of their most popular wide body models, and then it's pretty rigorous testing from the FAA. So I think that's going to quell some investor concern. And just as long as they can keep up with these deliveries, I think the balance sheet reconciliation will follow.
Yeah, I hadn't realized just how in lockstep it is with the S&P in terms of correlation. 0.98 over the last month. Now, I know that's a shorter time frame, but that's about as big as I've seen on a correlation. Frances Stacey, appreciate it so much. Hope you have a great rest of your day and a great weekend. Frances, of course, economic strategist and wealth manager for Scarlet Oak Financial. Joining me here in studio, host Fast Market, Tom White, as we look at an example trade or two here in Boeing. Tom, I know you guys talk Boeing a fair amount on Fast Market, but I mean, this seems even, unprecedented for Boeing, the amount of successes that they're having. And I know this has been a successful company throughout the years, but a lot going on the last few weeks.
Yeah, and it should. I mean, because the headline's been a bonus for Boeing. If you look at the orders that Frances mentioned there, especially the one from Qatar, I think that was the largest ever for Boeing at one time. And I think one of the key things you have to look forward to moving forward, because you can see there from the chart, parabolic move to the upside. We're getting overbought on an RSI level. It's above the 75 level at this point. So overbought, but that doesn't mean it can't continue to move higher. And remember, the next catalyst for this company, as President Trump and his administration goes through the Middle East, we'll probably see more orders. Paris Air Show starts June 16th. That might be another catalyst to the upside. So first trade I looked at, a little bit more bullish directionally, pretty straightforward on this one. Going out to that June 20th monthly cycle that expires in 35 days. So you'll capture the start of that Paris Air Show, and we typically see a lot of orders for airplanes during that show. So buying a bullish call vertical, where I'm going to buy the 205 strike call just out of the money to the upside, and then sell the 220 call. Because I want to reduce some of the exposure or risk on this directionally bullish position. $15 wide bullish call vertical. You're paying roughly about $5.50 debit. It's probably trading closer to $5 now because the stock has moved lower since I looked at this earlier. But the debit you pay is going to be your risk. If you pay $550 in risk, almost $1,000 in potential reward for that particular trade if it goes above 220. Now the break even on that, if you pay $550, 210.50 to the upside over the next 5 weeks, that's 3.5% above the current share price. So you don't need a monster move, but you want it to continue to grind higher over the next 5 weeks.
Yeah, and it's set up in a way that if the trend holds and it continues on this ascent higher, it's got some positive asymmetry. You're risking one to essentially make two. Now, I know it's 500 to make 1,000, but you get the point I'm making. Buying the at-the-money call vertical from an option strategy standpoint, if you think the stock's going to trend higher, is a strategy that achieves that goal. It needs a move. You need help from the stock to break even, but definitely in the realm of possibility given what we've seen from Boeing and all the news behind it. Got a different look at it, different style strategy, but can achieve similar goals.
Yeah, and a little bit more conservative, but a lot more risk because you're actually doing a naked option on the downside.
More capital intensive.
Yes, exactly. So looked out in the June 6th weekly cycle. So a little bit shorter duration on this one, about 21 days to expiration, where I'm going to sell a cash secured put as an example here, where it gives you a cushion to the downside, but it's still directionally bullish for the most part. So going out to that June 6th weekly cycle, we're going to sell the 200 strike put out of the money by about $3.50 to the downside. You're going to collect roughly about a $3.30 credit for that short put. So that's what you can make on this trade, $330 per put that you sell. But it takes your break even where you start to get punished on this one all the way down to 196.70. That's about nearly 4% below the current share price. So you're giving yourself that cushion. Now, because you're selling a cash secured put, it's naked, that if the stock does fall below 200, you keep that short put open. You have that risk of getting assigned on it, right? But this is that twofold type of trade. You're either selling this with the expectation, hey, it's going to remain above 200 or remain above that 196.70 break-even level, or you're willing to buy the shares if it does fall 4% from these levels. So you have to keep that in mind. But as you mentioned, more capital intensive on this, but you'd have to hold that short put if it falls below 200 to get assigned on it. So keep that in mind. You can always close it ahead of time if the market's open.
Yeah, I think that's a good caveat that just because that's essentially your risk is assignment being put the shares, and then of course you assume that full risk down to zero, and you got to put up the capital for that. That there is, of course, the option, no pun intended, to potentially close that out if you're able to react to it, markets open. But I do think it's important to stress you probably don't look at that strategy if you're not comfortable with potentially being a shareholder. Now, you may never become one. Even if the stock breaches your break even, you're tested and everything, you can try to do something to avoid that. But you're assuming that risk, so I think it's important that you probably consider it at least.
Yeah, and I think that's a key point with this type of strategy, especially because of the moves that we've seen in Boeing. It's like there's a lot of investors and traders out there going, man, I missed this move. I wish I could have bought it at 196.70. And this strategy takes advantage of that, where, hey, if it does fall back below 200, you do get assigned on the shares if you're still short that put. Hey, I'm willing to pay up to own the shares at a 4% discount to where they were trading in overbought territory.
Yeah, it's a strategy that has less volatility of returns because your break-even's inherently lower and you have defined profit. So the swings of the portfolio are smaller than if you just owned 100 shares of stock. Because that's really what you have to compare it to. I know it has a smaller delta, but that's your total risk. So I always compare it that way. But Tom, I'm going to keep you here for a second. We just got consumer sentiment. Consumer sentiment from Michigan, 50.8. Second lowest on record. Expected inflation for 1 year, highest since 1981, 7.3%. The estimate for that headline was 53.4. Now the market is either just shrugging this off and saying all clear, we don't worry about this, but those numbers and this market don't make sense together.
Well, I thought that this would be, you got to remember, this is a small sample size. This is a survey. There might be some political angles working in these numbers. We don't know. But I was surprised that we didn't see a bump up, especially after the trade tariff news. But this is 2 week, right? The preliminary, and then you have the final report. So you would expect that to start to come back, especially when you've seen the market bounce back. The S&P 500 is 22% above those lows that we saw at the beginning of April. So you'd expect these numbers to start to improve a little bit more. But I'm surprised they weren't a little bit. That 1 year inflation expectations, what did you say it was, 7.3?
7.3 is the highest since 1981 on that particular figure. If you were to look at expectations, 46.5, that's a downtick from 47.3 last time. 48.6 was the expectation, so they were expecting a pop. Current conditions, 57.6, below the 59.8. And then if you look at 5 to 10 year inflation, 4.6%. So I know that the pushback that, hey, it's political party breakdown suggests this, but that's not really the issue. The issue is whether or not this sample, which is limited, inherently all surveys are, is representative of the population it's supposed to represent. And I don't know, but what I'm telling you is the market is not trading like we're about to go into hyperinflation with 7.3% inflation. Treasuries are higher in price today. Yields are lower. They're not reacting this way. So the market is looking past this one.
And they maybe should, because that outsized number of 7.3% for 1 year inflation expectations, that's out of the realm of possibility at this point, just from the other hard data. Remember, this is a soft data point, and we always try to make that differential between the two, where the hard data has actually been pretty good. You saw the CPI, PPI data coming in better than expected on the downside, right? And then you're seeing, hey, this survey said that inflation is going to continue to ramp up. We haven't seen the full impact in the hard data from the tariff implications from the beginning of April yet. I think that's a key takeaway here, Alex. But I would look at this number and completely throw it out the window because jobs numbers are good. When people have jobs, wages are increasing. They're still out there spending. You look at it from stocks like Visa, MasterCard. You hear some rumblings out of Walmart on guidance moving forward that they might have to raise prices. I think that might throw a wrench into it.
Look, I'm not going to say to throw it out, but the expectation index is at 45-year low, okay? We, in the last 45 years, had the dot-com boom, we had 9/11, we had great financial crisis, we had COVID, okay? Times look a little bit better in the next 6 months to a year than it did at some of those points in time. It's just objectively the case.
Yeah.
Expected long-term inflation at 4.6, as I said, is the highest since 1991. So, interesting survey, nonetheless. We'll see.
Maybe not throw it out, grain of salt.